The IRS does not accidentally benefit from retirees with paid-off homes and full traditional IRAs. That combination is the single most cooperative tax profile in the entire American retirement system, and I can prove it with line items. The mechanism has 3 distinct layers. They interlock like gears, and by the time I finish walking you through all 3, you will never look at a zero mortgage balance the same way again. Your neighbor who kept his mortgage and invested the difference, he is not reckless. He is, in measurable, documented, calculable terms, decades ahead of you on a tax-adjusted net worth basis, and the math is not even close. Here is what is actually happening. According to research published by MeridianLink in March of this year, American homeowners are sitting on a near record $34.5 trillion in collective home equity. $34.5 trillion. That is the largest single pool of locked, frozen, zero-yield wealth in the history of this country. Nearly 46% of mortgage residences are equity rich, meaning their loan balance is less than half the home's value. Of the average $302,000 in equity held by mortgage holding homeowners, $195,000 is technically tappable. And yet, borrowers tapped just 0.41% of available tappable equity in the first quarter of 2025, still below long-term averages. Nobody is touching the gold bars. They buried them in the backyard and walked away. And that is the metaphor I want you to hold for the entire duration of this video. Your home equity is gold bars buried in the backyard. You can see the ground. You know they are down there. On paper, you are wealthy beyond question, but the cardiologist does not accept payment in topsoil. The HVAC contractor does not accept backyard excavation rights. And the Internal Revenue Service has been sitting patiently outside your fence for years, holding a backhoe and waiting for the moment you need a shovel. Because when you do need a shovel and you do not have your own, you will use theirs, and they charge 30% for the rental. That is the dead equity trap. And in a few minutes, I'm going to show you exactly what it costs in real dollars across 3 different states. But first, let me walk you through the trap itself, layer by layer, because you need to understand the mechanism before you can understand why the solution looks so counterintuitive. There are 3 layers to this. Layer 1 is the one everyone sort of understands. Layer 2 is the one almost nobody has mapped completely. Layer 3 is the one that specifically targets people whose spouses have died. This video covers all 3. The foundational lie first. The lie is this: a paid-off home means you are financially safe. You can hear it in every personal finance radio call-in from the 90s. You can read it in the paperbacks that were on the bestseller list when your parents were planning their retirement. The argument sounds airtight. No mortgage payment means no foreclosure risk. No foreclosure risk means permanent shelter. Permanent shelter means freedom. Therefore, maximum equity equals maximum safety. Here is the structural problem. In 2025's fourth quarter, American borrowers combined to lose roughly $78.8 billion in collective home equity. The average mortgage homeowner still sits on about $295,000. That equity number, what is it actually doing? What yield is it generating? What return is it producing while it sits inside your walls? 0%, not 0.25%, not 0.5%. The equity in your paid-off house earns exactly 0. The house may appreciate, sure, but the appreciation happens whether the house is mortgaged or not. The equity does not cause the appreciation. The land and the market cause the appreciation. Your equity is not a productive asset. It is an accounting entry. It is the government's way of measuring how much of the dirt you happen to own. Now compare that to the same dollars sitting in a broadly diversified equity portfolio. The compound annual growth rate of US stocks from 1926 through 2023 was over 10%, according to the University of Chicago's Center for Research in Security Prices. At a conservative long-run estimate of 8%, $500,000 compounding over 10 years becomes $1.79 million. $500,000 locked inside your foundation over 10 years becomes $500,000. The opportunity cost is not a small rounding error. It is more than the original number you started with. The wealthy figured this out generations ago. They keep a low-rate fixed mortgage. They let inflation gradually eat the real value of the loan balance over time. They keep their capital fully invested. This is called arbitrage. It is how every significant family balance sheet in this country actually operates. They are not in debt, they are leveraged. There is a technical difference between those two words, and that difference, measured over the lifetime of a retirement portfolio, is several $100,000. But I said there were 3 layers. And the first layer, the opportunity cost of zero yield equity, is actually the least surprising of the 3. In a few minutes, I'm going to show you what happens specifically at tax time when you try to access any of this, and the number is going to feel personal. But first, I need to tell you about a man named Frank. Frank is 68 years old. He retired 3 years ago from a career in manufacturing management in Columbus, Ohio. He has a paid-off house worth $450,000. He has a traditional IRA with $620,000, most of it pre-tax money. He deferred over 30 years. He collects Social Security of $31,000 per year. He has a small pension of $16,000 per year. By almost any conventional retirement metric, Frank is doing well. He is the example in the Sunday newspaper column. Frank's HVAC system fails in January. The whole unit. He gets 3 estimates. The cheapest is $17,000 because heat pumps in 2026 cost what mid-sized sedans cost in 2008. He also has a waterfall on his garage wall that turns out to be a drainage problem the inspector missed in 2009, another $11,000. He has built up cash, but not for $28,000. So he does what almost every retiree in his position does. He logs into Fidelity, requests a $28,000 distribution from his traditional IRA, and moves on with his life. Here is what happens next. The $28,000 hits Frank's adjusted gross income as ordinary income, every dollar. The IRS does not care that it was an emergency. The IRS does not care that the heat pump failed in January. That withdrawal is income, full stop. His pension of $16,000 plus his IRA withdrawal of $28,000 gives him $44,000 in non-Social Security income for the year. Now we run the Social Security taxation formula. The IRS determines whether Social Security benefits are taxable using combined or provisional income tests with 2 tiers. Below the lower threshold, no benefits are taxed. Between the lower and upper threshold, up to 50% of benefits can be taxed. And above the upper threshold, up to 85% of benefits can be taxed. For 2026, the lower and upper thresholds remain $25,000 and $34,000 for single filers. Frank is single. His provisional income is his non-Social Security income, plus 50% of his Social Security benefit. $44,000 plus $15,500 equals $59,500. He cleared the $34,000 threshold without breaking a sweat. 85% of his $31,000 Social Security benefit is now taxable. That is $26,350 of Social Security income dragged into the taxable column. He did not plan for that. He did not expect it. Here is the part that should genuinely upset you. The lower provisional income thresholds of $25,000 for single filers and $32,000 for joint filers have been unchanged since 1984. The upper thresholds of $34,000 and $44,000 have been unchanged since 1994. Those numbers have not moved. Social Security benefits are indexed to wage growth and adjusted for inflation, whereas the provisional income thresholds used to determine the taxable amount of benefits are fixed by statute and not indexed for inflation or wage growth. In 1984, less than 10% of beneficiaries paid federal income tax on their benefits. Today, closer to half do. The tax is creeping upward in slow motion, and the retirees who pulled the most money into tax-deferred accounts are the ones hitting these thresholds hardest. So Frank owes federal income tax on roughly $44,000 in pension and IRA income plus $26,350 in taxable Social Security. Call it $70,000 of total taxable income before the standard deduction. After deductions, he is looking at federal taxes somewhere in the range of $6,000 to $9,000 depending on his specific deduction picture. Ohio takes another $2,000. Local takes another $500. Let's call his total immediate tax bill on that $28,000 withdrawal somewhere around $11,000 to $12,000. He kept roughly $16,000 of the $28,000 he pulled. But we are not done with Frank. Not even close. Because here is the layer that almost nobody connects until 2 years have passed. Stay with me, because this next part is the reason I made this video. IRMAA, the income-related monthly adjustment amount, is the Medicare surcharge that applies when a beneficiary's modified adjusted gross income exceeds certain thresholds. The surcharge is added to the standard Medicare Part B and Part D premiums. And here is the brutal mechanical detail that makes this so dangerous. The surcharge is based on your modified adjusted gross income from 2 years ago. In other words, your 2026 IRMAA liability is based on your MAGI from 2024. Frank pulled $28,000 from his IRA this year. He will have completely forgotten about the HVAC by the time his Medicare letter arrives. The Medicare surcharge in 2026 applies to beneficiaries with income exceeding $109,000 for single filers. Frank's income did not hit that. But here is the scenario that does. A single retiree with a higher pension, say $40,000 a year, combined with Social Security of $36,000, who pulls $50,000 from an IRA for a medical emergency and a roof, now has total income of about $126,000. That obliterates the $109,000 single filer IRMAA threshold. IRMAA works as a cliff system, meaning exceeding an income threshold by even $1 can trigger the full surcharge for the next tier. If your income crosses into the next bracket by $1, your Medicare premiums can suddenly jump by over $1,000 per year. And because it is based on income from 2 years prior, there's nothing you can do about it retroactively. The bill shows up 2 years later like a rent increase nobody warned you about. In 2026, the IRMAA surcharges and Part B premium increases far exceed the Social Security cost of living adjustment, meaning retirees receiving Social Security will see their Medicare premiums rise more than 2.5 times faster than their Social Security benefits, potentially reducing their net income. And that is before a single emergency IRA withdrawal. Add one bad year of cash needs, and you have created a Medicare premium problem that trails you for 2 years minimum. By the way, hit subscribe. If you find content like this valuable, the algorithm needs the signal, or it will stop showing you this channel and serve you budgeting tips instead. Subscribe, flip the bell, let's continue. Now I want to show you what the HELOC does to this entire problem. 2 years before the emergency, when Frank was 66 and still had excellent credit and a recent income history, he walked into a credit union and applied for a home equity line of credit. Not because he needed the money, because banks give you the umbrella when it is sunny and take it back when it rains. And Frank had been paying attention. He got a credit line of $120,000 at a competitive variable rate. He signed the paperwork, stuck it in the fireproof safe next to the deed, and did not touch it for 2 years. The HVAC fails. The drainage problem appears. Frank needs $28,000 by next week. He logs into the credit union website and draws $28,000 from his HELOC. Federal tax on a HELOC draw? 0. Borrowed money is not income. It never has been. The IRS cannot tax a loan because a loan is a liability, not earnings. Every dollar of that $28,000 arrives in his checking account as $28,000, no withholding, no shrinkage, no shadow tax. Borrowed money is not considered income, so it is not subject to income tax. You do not have to sell any assets, so no capital gains taxes are triggered. His provisional income for Social Security purposes does not move. His MAGI for IRMAA purposes does not move. His IRA stays fully invested at 8%. The gold bars stay in the backyard. His backyard, most forecasters expect HELOC rates to remain in the 7 to 8% range through 2026 and potentially decline further if the Federal Reserve resumes rate cuts. So the cost of Frank's HELOC on a $28,000 balance at 7.5% is roughly $2,100 per year in interest. He pays that down over 3 to 4 years from disciplined, controlled, bracket-aware withdrawals from the IRA, taking small amounts in low-income years, staying below thresholds, never triggering an IRMAA Cliff or a Social Security cascade. The total interest cost across the payoff period is maybe $5,000 to $6,000. Against the $11,000 in taxes he would have paid in the liquidation scenario, and against the compounding he preserved by keeping the IRA intact. Over a 15-year window, the difference between these two choices, IRA liquidation versus HELOC bridge, is well over $80,000 in real wealth from a single $28,000 emergency because of one decision about which shovel to use. Here's the part that connects to a broader story. A story about a woman named Carol, which I am going to come back to in a few minutes. Because what happens to Carol makes everything we just talked about look mild. Hold that thought. Here is where the mainstream financial advice machine fails you completely. Your advisor, if you have one, was trained in a framework built around accumulation. Accumulate in the 401k. Maximize the contributions. Let the money grow. Then spend it down in retirement at a sustainable rate. 4% rule. The math works. Congratulations. What the accumulation framework does not address is the interaction between a large tax-deferred account and a paid-off primary residence, because that specific combination creates a situation where every dollar you need in an emergency costs you significantly more than a dollar to access. The 401k was designed as a wealth-building tool. It was not designed as a rainy day fund. But that is exactly how most paid-off home retirees are using it, because it is the only liquid asset they have left after they buried all their gold. Here is how I built something to address this directly. The research I did building the exit code is the same research I used to understand why the standard retirement math keeps failing people who followed all the rules. The exit code is a digital book built on 50 years of actual retirement data. Not opinion, not vibes, data. 8 chapters, no filler. The specific problem I just walked through, the IRMAA, 2-year echo, the Social Security provisional income trap, the mechanical interaction between a large IRA and a zero-yield home equity position, this is the kind of problem the exit code was built to quantify and solve. 2 elements that are directly relevant to what we just covered. The 4% trap is chapter 4, and it details a dynamic withdrawal method that replaces the static 4% rule with a framework that actively manages which account you pull from in which year based on your current bracket position, your IRMAA threshold proximity, and the taxation status of your Social Security. The second element is what I call the lazy portfolio, which is built on 50 years of historical return data and has consistently outperformed active traders over 30-year windows because it compounds instead of churning. The people who needed liquidity and had it in the right places are the ones who let the boring assets keep working undisturbed. You can get the exit code for less than 1 hour with a mediocre financial advisor through the link in the description. Every year you delay structuring this properly, the compounding math works against you with the same relentlessness it would have worked for you. Now, the escalation. Because everything I've described so far is the trap in normal conditions. Let me tell you what happens when the conditions get worse, which they always eventually do. Individuals born between 1951 and 1959 must begin taking required minimum distributions in the year they turn age 73, under Secure 2.0. This is the IRS's mechanism for collecting the tax you deferred for 30 years. You do not get to defer it forever. At 73, the government starts requiring that you pull money out of your traditional IRA on a schedule based on your life expectancy, whether you need it or not, whether the market is up or down, whether you have an emergency that year or not. Here is the specific collision I want you to understand. Most retirees with large traditional IRA balances and decent Social Security benefits already have baseline income close to or above the SS provisional income thresholds by the time RMDs kick in, the pension comes in. Social Security comes in, some part of that Social Security is already being taxed. Now the RMD starts, maybe it is $25,000 in year 1 on a $750,000 IRA balance. That $25,000 stacks on top of everything else. It pushes more of the Social Security into the taxable column. It can push total income toward IRMAA thresholds. And if there is a separate emergency that year that requires another $20,000 from the IRA on top of the mandatory RMD, you have now created two taxable events in the same calendar year, both interacting with the same set of provisional income thresholds, both contributing to the same IRMAA lookback. The people who have the HELOC in place by age 73 have a safety valve. The emergency gets funded by the HELOC, not by an additional IRA withdrawal on top of the forced RMD. The bracket stays manageable. The IRMAA threshold stays below the horizon. The Social Security taxation rate stays capped. The IRA grows undisturbed except for the mandatory minimum, which itself can sometimes be offset through qualified charitable distributions if the retiree is charitably inclined and the math makes sense. Every tool in the toolkit depends on having liquidity infrastructure in place before the tool is needed. The retiree who has no HELOC at 73 has no flexibility. Every emergency is an additional IRA draw. Every additional IRA draw is an income event. Every income event interacts with 4 or 5 other income thresholds simultaneously. The tax code at this income level is not a straight line. It is a series of cliffs, and each cliff you step over triggers something on the next ledge. Here is something an advisor will tell you only if you ask directly, and most people never ask. A required minimum distribution can push Social Security benefits into taxable income, increase Medicare premium exposure, reduce room for capital gain planning, or change the value of Roth conversion work. 4 separate consequences from one mandatory transaction. That is not a bug in the retirement tax code. That is the architecture of it. Now, Carol, I told you to hold that thought. Carol is 71 years old. She and her husband, Dennis, did everything the personal finance playbook told them to do. They paid off the house in Columbus. It is worth $420,000. They had a combined traditional IRA balance of $710,000. They collected joint Social Security totaling $53,000 per year. Dennis had a pension of $18,000. Their combined income was comfortable. Their tax burden was manageable. They were the success story. Dennis died 14 months ago. Cardiac event. Very fast. Carol is now a single filer. This change in filing status is the 3rd layer of the debt equity trap, and it is the one that gets the least attention in any personal finance content I have ever seen, which is genuinely strange because widowhood is not a rare event in the American retirement population. It is extremely common, and it is financially catastrophic for exactly the reasons I'm about to describe. The Medicare surcharge in 2026 applies to beneficiaries with income exceeding $109,000 for single filers and $218,000 for joint filers. Carol and Dennis, filing jointly, were sitting at roughly $71,000 in annual income, far below the $218,000 joint threshold. IRMAA did not apply to them. After Dennis dies, Carol's income drops because she loses Dennis's Social Security and her pension income shifts. But here is the trap. Her own Social Security benefit stays. Her own share of the IRA stays. And the thresholds that protected her as a joint filer have just been cut in half. The Social Security provisional income threshold for triggering 85% taxation is $34,000 for a single filer. Carol was nowhere near that as a joint filer. As a single filer, with her own Social Security of $28,000 plus the IRA income she needs to draw to live on, she crosses that threshold in the first year after Dennis's death without pulling a single emergency dollar. The same income is now taxed more harshly than it was 2 years ago, simply because her filing status changed. And the gold bars are still in the backyard. Every one of them. Carol needs $40,000 for dental work and a roof repair. She has the equity. She does not have the liquidity. She has never set up a HELOC. Dennis handled the finances. The one time they looked into it, the rate seemed high, and they decided they did not need it because the house was paid off and they had the IRA. She now applies for a HELOC at 71, recently widowed, with reduced income and a recently disrupted financial picture. First quarter second lien equity withdrawals rose 22% year over year to nearly $25 billion in early 2025. The largest first quarter volume in 17 years. Lenders are opening up. But the terms Carol qualifies for are not the terms she would have qualified for at 65 with Dennis's pension income still on the application. This is the subplot resolution. Carol represents the single largest unaddressed vulnerability in the paid-off home retirement model, which is the filing status transition and the dramatic threshold cliff that comes with it. The married retiree who plans in a vacuum, assuming joint filing status for the duration of retirement, is doing incomplete math. If your income exceeds certain thresholds, you could pay nearly $10,000 per year in Medicare premiums. The frustrating part? Most retirees do not find out until they get a letter from Social Security after it is too late to do anything about it. The liquidity bridge has to be set up before the crisis by both spouses while credit is strong and income is stable. That is the insurance against the filing status cliff. And the filing status cliff, it is worth saying clearly, is not something anyone at the Personal Finance radio station will tell you about, because it requires actually thinking through a scenario most people do not want to think about. Let me show you the complete picture through one realistic scenario before I give you the practical steps. Barbara is 67, a retired elementary school principal, paid off home in suburban Atlanta worth $490,000, traditional IRA of $740,000, mostly pre-tax, Social Security of $34,000 per year, pension of $16,000 per year, total baseline income of $50,000. She is married, filing jointly with her husband, who has modest investment income of about $12,000 per year. Combined, they bring in $62,000 per year. Safe, manageable, year one of retirement, a hailstorm. Professional roof replacement costs $9,541 on average. But Barbara has a larger, older home, and the damage is significant. Her contractor quotes $18,000. Her husband needs a surgical procedure that their Medicare Advantage plan partially covers. The out-of-network specialist adds $22,000 in out-of-pocket costs. The bill is $40,000. Barbara calls her financial advisor. Her advisor says, withdraw from the IRA. Standard advice, common advice. Barbara logs in and takes $40,000 from the traditional IRA. Here is what that costs her in the year it happens and in the years that follow. Federal tax. The $40,000 adds to their $62,000 baseline, putting total income at $102,000. Their SS provisional income is now $62,000 plus. $20,000 times 50% of their combined Social Security, call it $20,000 provisional from SS, total provisional income around $82,000. The 85% Social Security taxation threshold for joint filers is $44,000. They cleared that easily at baseline. All 85% of their SS is taxable. The total federal tax hit on the $40,000 IRA withdrawal, considering their marginal bracket and the SS cascade, comes to somewhere between $8,000 and $11,000 depending on deductions. Ohio state income tax, roughly another $2,000. Total immediate tax cost on the $40,000 withdrawal, approximately $10,000 to $13,000. She kept between $27,000 and $30,000 of the $40,000 she pulled. 2 years later, her income is being evaluated for IRMAA purposes. At $102,000, they remain under the $218,000 joint threshold for 2028. She escapes IRMAA this time, but if the roof had been $30,000 and the medical bill had been $40,000, putting the withdrawal at $70,000 instead of $40,000, the combined income of $132,000 would still be under the joint threshold. The IRMAA trap is a steeper cliff for single filers and higher income retirees. Barbara, for now, gets through this particular incident without triggering it. But she lost $11,000 in taxes. And the $40,000 in her IRA that is now gone, at 8% compounding over the next 15 years of her retirement, that $40,000 would have grown by an additional $93,000. Total cost of the IRA liquidation decision over 15 years, $104,000 from one emergency, from one decision to use the IRS's shovel instead of her own. Now run the HELOC scenario. Barbara's husband, when they retired, spent an afternoon at 3 different credit unions, got quotes, found a competitive rate, established a line of $150,000 cost, a small origination fee, and an afternoon of paperwork. The line sat dormant for 18 months. The hailstorm hits. The surgery bill arrives. Barbara draws $40,000 from the HELOC. Tax event, none. IRMAA exposure, none. Social Security provisional income, unchanged. IRA, fully invested, generating approximately $59,000 in expected growth that year on the $740,000 balance at 8%. The interest on the HELOC at a rate of around 7.5% on a $40,000 balance is about $3,000 per year. She pays it down over 4 years using controlled IRA draws calibrated to stay under provisional income thresholds and well below any IRMAA Cliff. Total interest paid, approximately $7,000 across the payoff period. Total cost of the HELOC strategy over 4 years, $7,000. Side by side, $10,000 to $13,000 in immediate taxes plus $93,000 in loss compounding versus $7,000 in HELOC interest. The HELOC strategy saves Barbara somewhere between $96,000 and $99,000 over the 15-year window from one emergency, one decision. The gold bar stayed buried. She borrowed against the ground. She paid back the loan. The gold kept appreciating. The IRS never touched it. There's a moment in most financial advisors' offices that I find extremely telling. Client walks in, says, my roof is going to need replacing next year, and I need to access some cash. Advisor looks at the portfolio, sees the IRA, says, we'll take a distribution. Client says, but what about the taxes? Advisor says, oh, you'll just owe your ordinary income rate. Should be manageable. And the client nods, because manageable sounds fine, and because the advisor's office has nice chairs and a good view, and because the advisor is not wrong about the nominal tax rate. What the advisor did not model, the Social Security provisional income cascade, the IRMAA echo 2 years later, the opportunity cost of the removed capital at 8% compounding over the remaining retirement horizon. Total cost, unmeasured, unmodeled, sitting quietly in the gap between ordinary income rate and everything else. The average 65-year-old retiring in 2025 can expect to spend about $172,500 on healthcare and medical expenses during retirement, not including potentially catastrophic long-term care costs, according to an annual survey by Fidelity. According to Milliman's 2025 Retiree Health Cost Index, a healthy 65-year-old woman retiring can expect to spend approximately $313,000 on healthcare over her lifetime. A 65-year-old man can expect to spend about $275,000, $313,000, not counting long-term care, not counting dental, not counting the home maintenance bill that runs alongside it. Medicare Part B premiums have jumped 9.7% to $202.90 per month in 2026, crossing $200 for the first time ever. The Part B deductible rose to $283, and the Part A inpatient deductible climbed to $1,736. Health-related cost inflation is projected to rise by 5.8% over the long term, more than double the 2.8% Social Security COLA for 2026. Your retirement is a $300,000 healthcare bill, an aging house, and a Social Security system whose taxation thresholds were frozen in a year when the Dallas Cowboys had 3 Super Bowl rings. Those are the actual variables. The paid-off house does not appear anywhere in that equation as a solution. It appears as a complication. Here are the 3 specific actions you take this week, this month, and this quarter. First, get the HELOC in place now. Not next year, not when you feel like you need it. As more than one person has observed, banks are eager to lend you money only if you can prove that you don't need it. That is the whole game. The credit line has no value if you apply for it at 74 with reduced income and a recent health event on your record. You walk into 3 credit unions and 1 regional bank this month. You compare draw periods, repayment periods, rate indexes, margins, floors, ceilings, annual fees, inactivity fees, and closing costs. You pick the best one. You sign. You file the paperwork next to the deed. You do not touch it unless you need it. The cost of establishing a HELOC you never use is a few $100s in origination costs and 1 afternoon. The cost of not having one when you need it is what we just calculated. Second, map your IRMAA brackets and your Social Security provisional income thresholds onto a single document right now. The Medicare surcharge in 2026 applies to beneficiaries with income exceeding $109,000 for single filers and $218,000 for joint filers. The upper threshold for 85% Social Security taxation is $34,000 for single filers and $44,000 for joint filers. You need to know exactly how much room you have between your current baseline income and each of these cliffs. That headroom number is your strategic IRA withdrawal budget for any given year. If you have $15,000 of headroom before hitting the IRMAA single filer threshold, you can pull $15,000 from the IRA this year with predictable tax consequences. You cannot pull $45,000 without understanding what happens to the next 6 thresholds. Get a fee-only CPA, a fiduciary advisor, or quality tax software and spend one afternoon mapping this, then laminate it. Third, strategic Roth conversions. Converting a traditional IRA to a Roth IRA create a one-time spike in income. If you do this before you are within the 2-year Medicare look-back window, typically before age 63, you can enjoy tax-free withdrawals later that do not count toward modified adjusted gross income. The window between retirement and the start of required minimum distributions is your golden conversion corridor. You generally must start taking withdrawals from your traditional IRA and retirement plan accounts when you reach age 73. The years between retiring and 73 are the years where controlled, calibrated Roth conversions, sized to stay below IRMAA thresholds and below Social Security taxation cliffs, can permanently reduce the size of the tax-deferred IRA, permanently reduce future RMD exposure, and permanently expand the pool of tax-free money you can access in any emergency without triggering any of the cascades we discussed. The Roth IRA, once funded, is your clean shovel. Withdrawals after 59.5 are tax-free. They do not count toward provisional income for Social Security purposes. They do not count toward MAGI for IRMAA purposes. They do not stack on the bracket. They do not interact with anything. They are the gold bars you can actually spend. At its core, buy, borrow, die is a strategy designed to leverage appreciating assets, access cash, and ultimately pass wealth to heirs in the most tax-efficient manner possible by avoiding capital gain taxes. The tax code wipes out any tax liability for capital gains by stepping up the baseline value of assets from the original price to their value at the time of the benefactor's death. The people with the estate planners and the private bankers have understood this for generations. They borrow against assets during life. They let the assets compound undisturbed. They pass the assets at a stepped-up basis at death, and the heirs either sell with zero embedded gains or continue the cycle for another generation. The information is not hidden behind a paywall. It is in the tax code. It is in every estate planning textbook. It is taught in continuing education courses across the country. It is just not on AM radio because it does not fit on a bumper sticker, and because the person selling the bumper sticker has a very specific interest in you staying confused. Now, one final note on Carol. Carol eventually found an estate planning attorney and a fee-only CPA working together who mapped her situation correctly after Dennis died. She established a HELOC on a reduced but still favorable income basis. Not the $150,000 she could have gotten at 65, but enough. She began a disciplined Roth conversion strategy, pulling small amounts from the traditional IRA each year, staying under the $34,000 provisional income threshold, converting slowly, permanently reducing the future RMD burden on an account that will continue to grow until she is forced to take distributions. She is 3 years into the plan. She has moved $112,000 from traditional to Roth at a marginal federal rate of 12% in years where the conversions were small enough to barely move her Social Security taxation needle. The gold bars are still in the backyard. But she has her own shovel now, and she knows exactly where to dig. The paid-off house is not the problem. The house is neutral. It is the combination of a paid-off house, a large tax-deferred account, no liquidity bridge, and no bracket map that creates the problem. Those are 4 separate variables, and you can control 3 of them starting this week. The 4th, the house, will appreciate or not based on the market and the county assessor and forces entirely outside your control. Lazy investing built more fortune than crypto memes. The IRS Christmas card you are sending them is postmarked every year you delay building the infrastructure to stop it.